The S&P 500, NASDAQ, and Dow Jones are having an unbelievable year thus far. Larry Fink, self-made billionaire and founder of BlackRock, the largest asset manager in the world with $6.2 trillion under management, is claiming there is a risk of a melt-up, which is the popular theory that bull markets, all of them, end with euphoria. And we haven't seen one yet this cycle and are about to. On the flip side, Bridgewater Associates, world's largest hedge fund in the world, claims that U.S. corporations have hit peak margins and that deglobalization will cause a 40% drop in U.S. equity prices. In today's interview, Wealth Research Group focuses on alternative investments, those made outside the stock market. The interview also shows ways of getting rid of student loans, 30-year mortgages in 5 to 7 years, and other critical debt and credit solutions. It's a critical interview. Enjoy this one.
Welcome to the Times of Industry show. Today's show, man, I hope the Minister of Education is watching this along with pension planners, and I hope university deacons are viewing this as well, because today's guest has ideas and strategies that are critical to teenagers, students, people that are in their prime, and retirees that are looking to retire in today's America with today's reality, because today's interview is about creating wealth in these circumstances, in this environment, and it's all about taking simple steps when it comes to the 4 biggest challenges that all everyday viewers face, which is credit, debt, mortgage, high yield, and protecting your primary engine, which is your career, from income outside of the stock market. So we're not going to touch a lot of stock market today, but we are going to talk about alternative ideas within the stock market. Jordan Goodman's show is actually called Money Answers, and he is an author of some amazing financial books that I absolutely respect his ability to generate some practical ideas for listeners every single time. And I'm glad to have him back on the show. In fact, I know people that have took advantage of some of the tactics presented the last time he was on this show, and has helped them to save tens of thousands of dollars in real money. So, Jordan, thanks for coming back on the show.
Great to be with you again, Leo. Appreciate it.
I want to ask you, I'm aware of your time restraints, so I want to jump right into this. Sure. and have a great show. What are your 4 top ways of generating steady, either monthly or quarterly interest payment income, and maybe even some capital appreciation for people who do have cash, even micro bits of cash, $1,000, $2,000, etc., not $100,000 or more, but they don't want to do any junk bonds or muni bonds or bonds in general, I guess, and they want to do something else.
Okay, let me give you my 4, and I'm going to not only give you the idea, but give you some specific examples that I think are very good. First one would be publicly traded real estate investment trusts, or REITs as they're called, because they're institutional holdings of maybe apartment buildings, office buildings, shopping centers, hospitals, government buildings. There's just all kinds of different ways of doing it. And they, as long as they pay out 90% of their income to shareholders in the form of dividends on a quarterly or monthly basis, they don't pay tax at the corporate level. So they've got a bit of a tax break there as well. So their yields are much higher than other stocks, typically 7, 10%, something like that. So I'll give you just a few examples. Annaly Capital, symbol NLY, is a mortgage REIT. It's got a yield of about 10%. Gladstone Commercial, symbol GOOD, does commercial properties all over the country. Whitestone REIT, symbol WSR, has apartment buildings all over the country. So those have yields in the 7 to 10% range. So that would be the first one, publicly traded REITs. The second one would be so-called MLPs, or Master Limited Partnerships. So basically what these do is, in the energy space, they do oil and gas pipelines, and they collect money as oil and gas goes through the pipelines. It's kind of like a toll road, Leo. It's like you set up the toll road, they collect the tolls as the oil and gas goes through. Very consistent yields, and it's not dependent on the price of oil and gas, but how much throughput is happening. I'll give you some examples of ones I like there. There's one called Enterprise Products Partners, probably the biggest MLP out there. EPD is the symbol on that one. There's another one called Magellan Midstream Partners. MMP is the symbol on that one. They're in the kind of middle stream area. And then there's a fund that actually has a diversified portfolio of MLPs called the Cohen and Steers MLP Income and Energy Opportunity Fund, symbol MIE. Got about an 8% yield. So you have a diversified portfolio in that. So that would be number 2. REITs, MLPs. The next one are so-called BDCs, or business development companies. What they do is they lend money, and in many cases get equity participation in medium and small sized companies that have hard times getting loans from traditional banks. Perfectly good loans, but they're going to get a higher yield because they're taking a little bit more risk. So they do it for you. Same thing. They don't pay tax as long as they pay out 90% of their income to you and the shareholders. 7, 9, 10% yields on these kind of things. I'll give you some examples. Ares Capital, ARES Capital, symbol ARCC. Stellus Capital, symbol SCM. And TCG BDC, symbol CGBD, those all have yields in the 7 to 10% range. Very consistent. Their stock prices don't move very much at all. And the last one would be global high income funds that have a diversified portfolio of stocks and bonds around the world that have some pretty nice yields. Give you some examples. There's one called the Nuveen Global High Income Fund, symbol on that JGH. There's another one called the Global X Super Dividend Fund, symbol SRET. And finally, there's a Flaherty and Crumrine Preferred Income Fund, FFC. And those also have yields in the 7 to 9% range. So those are 4 categories, Leo, that you can get some pretty nice yields without having much fluctuation these days.
Yeah, obviously they're all publicly traded. So one thing that is important to remember about them, tell me if you're agreeing with me, is that sometimes they trade with the markets in terms of if there's a smash down, nothing happens to their real estate portfolio. They're collecting those rents, but still the price can go down 20%, etc.
It can. You're right.
Yeah.
I mean, these are, in general, they're relatively stable. They might move $1 or 2 or 3 a year. But yes, things can go down as well as up. But the purpose of them is income. If you're getting between 7 and 10% income, and quite a few of those are actually on a monthly basis, it doesn't really matter to you what the stock price is doing very much in the short term.
Sure. If you're only concerned with the income and there's not a lot of leverage involved
Right.
with paying out these yields, then the fluctuation in the underlying equity is less important than the income. With that said, obviously, if you want to ever liquidate the position, you're obviously concerned with either appreciation or depreciation. With MLPs, they obviously follow the price of the underlying oil or natural gas far less than the producers and all the people that actually are involved with the production of it. But obviously, great ideas out there, and depending on when you hear this interview, obviously the price can be much different than when you heard of today. And the fact that you like a given company doesn't mean that it's a great opportunity per se. It's a company that is a great company, but it may not be attractive in the price. So that's also important to point out.
Sure. These have had long-term track records. These are not giant companies. These have been around a long time.
Yeah,
you're right. They can move up and down for sure.
Sure. I've actually owned at the outset of the financial crisis. I owned Anelli, which is one of the companies that you covered. They actually had a 16% yield when I got involved in EPD, which is a very large MLP. That was also a holding of mine at some point in my career. I want to ask you, moving forward, do you personally believe that interest rates are going to stay low for long, or that the world has had enough of lending Washington money at these bullshit rates? Where do you think interest rates are going?
I think they're going to stay low for quite a while, even though we have these huge deficits. In Europe, there's something like $10 trillion worth of bonds selling at negative yields today, literally -1%, -2%. And I think with what's about to happen with Brexit and the European Union breaking up, that's a deflationary event. Rates could go even lower in Europe. So compared to that, our rates look pretty good. 2.5 roughly on 10-year treasuries, maybe as much as 3% on 30-year treasuries. I think it's going to stay in that range for quite a while. It's quite amazing, Leo, when you think of the amount of deficits we have. We're adding $1 trillion in deficit every year to a roughly $22 trillion pile. But as long as people around the world see us as a safe haven, they're going to keep pouring money in, which makes the value of the dollar goes up, which keeps our interest rates down. So I do not see any spike in interest rates. Interest rates would go up if there's a big fear of inflation. If anything, I think it's more worries of deflation right now. So I think interest rates are going to stay low for a long time.
Yeah, and you bring up two great points. One is that we don't live in a vacuum. So 2.5% on the 10-year might seem low on absolute terms compared to historical 10-year yields, which were about 5%. But if you look at where else you're going to put trillions of dollars, and you look at countries that are like Spain or Italy or Greece, etc., or Japan, much smaller with a less robust economy, etc., and they yield even lower returns than a country that is involved with a quarter of the world's GDP, then 2.5% sounds better. But what I find very fascinating is that so much money is chasing these bonds, so much capital is chasing these bonds and not chasing other opportunities, and they're sure to lose. So these are fund managers that are saying, hey, I'm going to lose 1%, but I'm going to limit my loss to 1%. At least I have that banked. If the stock market does far worse, I'm not going to be suffering from that. I'm locking in my loss at a very low loss, and that is very deflationary and very interesting that happens to such a large degree, to the tune of trillions of dollars.
We've never had a situation like this before, Lior, where we have trillions of dollars trading at negative interest rates, and it's only going to get bigger. I mean, the European Central Bank has been pouring money out to try to stimulate the European economy for years, and it really hasn't worked that much. Despite having poured out many, many billions and trillions of euros, you still have negative interest rates. That's telling you how weak the economy is in Europe.
Yeah, just to follow up on that, it's very important because what you bring up is a point where in the U.S., all of the money that was, or a majority of the currency that was printed, went into equities and went into the stock market and real estate. In Europe, it didn't go to the same effect. The European stock markets are not roaring as the U.S. stock market is, nor real estate prices over there. I want to ask you 3 top ideas about generating high yield income outside of the stock market. Okay, we talked about MLPs, REITs, preferreds, etc. Talk to me more about private ways to do it that don't fluctuate in price on an everyday basis on the stock market.
The first one clearly would be rental real estate, where you own either homes, apartments, mobile homes, storage facilities. There's lots of ways of things that produce regular income where the price of them is not going up and down at all, certainly not every day. And there are people that put together entire portfolios, and there are strategies to do these things where you can buy them from distressed sellers and get really good deals on them and get a nice flow of rental income, put an entire portfolio together of homes, apartments, whatever it may be. That would be the first one. The second would be preferreds, which are kind of stocks, but they're really kind of a form of bond. You can get yields of 5-6% on those today. I mentioned earlier one of the funds. You can either do individual preferreds or there are exchange-traded funds, publicly traded funds that do preferreds. Another one would be hard money lending in commercial real estate. This is where you lend against a specific piece of property. You have a first position commercial mortgage on it, and you get a yield of 10% or thereabouts, typically 1 year to 18 months, something in that range. And then if they default, you get to buy the building, at a good price. But usually they pay pretty well. And you can either do that directly. There are funds that do diversified portfolios of hard money loans. So those would be 3 ways of getting some nice yields that are kind of separate from the stock market.
Is there a specific fund for those lendings that you are involved with or have used or have researched, etc.?
Not a specific one. There are. If you actually just Google like hard money lending, you'll see tons of funds that offer things in there. They're typically called Regulation D funds that you can invest in. That's an easy way to do it. And the same thing with rental real estate. You can do it yourself. There are people that will do it for you and put together a very nice portfolio of highly qualified secure income real estate all over the country.
Yeah, what we call turnkey real estate,
Right.
and there are many vendors that do that, and some of them are very, very reputable and good. Let's switch to debt.
Sure.
People are frustrated. People are drowning in debt. You got credit card debt, auto loans, student debts. Um, you know, it's all about finding ways to close down debt levels, cut expenses. Do you have some life hacks, some
Sure.
practical services that people can use in ways that people of all ages can help to limit their debt or close it altogether?
Absolutely. Let's start with student loan debt, which is the fastest growing, about 1.5 trillion in student loan debt outstanding. In many cases, it's some pretty high interest rates if you have private student loan debt. So what you want to do there is refinance the student loan debt, combining federal loans and private loans into one at a lower rate of typically in the 3% range these days. My favorite place is called Splash Financial. So their website would be Splash Financial, and then you do /money answers. They know it's me that way. You get a particularly good deal. I think you actually get $300 off your first loan payment when you do it with the money answers. And so that's a way of refinancing all those student loans into one at a lower interest rate. That would be on student loans. As far as credit cards, there are much better deals out there to be had than most people get. Certainly what you get in the mail, Leor, is the worst deal. Those are the highest interest rates, biggest fees, and so on. A free website to get the best deals is guidetocreditcard.com. There are low interest rates. There are frequent flyer miles if you want that. You can get cash rebates of as much as 6% back on your money. There's loads of great deals out there. You just got to go get them to that free website, guidetocreditcard.com, and do what I call credit card surfing. Surf your balances from high rates down to lower rates. In many cases, you can do a 0% balance transfer offer for 6 months, a year. And as long as you pay it off, you can pay no interest whatsoever. So that's a good way on credit cards. The next one would be healthcare debt. There's well over $1 trillion in healthcare debt. It's crushing an awful lot of people. Because of the recent changes in the tax law, people do not have to get healthcare. There's no more mandate to get healthcare. So some people are going without healthcare, which is great until you need it. And then you're really up the creek because it can be very, very expensive. So there are companies out there that do so-called healthcare advocacy that help you negotiate down healthcare debt to pennies on the dollar. I saw somebody recently, he had a $200,000 bill for a heart attack that he had. It was negotiated down to like $3,000. So my favorite place is called Healthcare Advocates at healthcareadvocates.com. They've done this for many, many years. They scrutinize the bill and get it down and then negotiate it so you can get out from the huge burden of healthcare debt. And then one last way is a lot of people have life insurance policies they don't really need. And if they sell those life insurance policies in what's called the life settlement market, they can use that money to pay off all their debts. And the insurance company or insurance agent will never tell you you've got a life insurance company, a policy that's worth a lot. My resource there is called fundinglife.com. And you show them life insurance policy you have. They'll tell you how much it's worth. People buying it will hold on until you die, and then they collect the death benefit. Say it's $1 million policy. They sell it. You sell it to them for like $200,000. When you die, they get the $1 million, that kind of thing. Hedge funds and so on buy life insurance policies. So that's an asset a lot of people don't even know they have. At fundinglife.com, they can see what it's worth and go through the whole process of matching you as the life insurance policy seller with buyers and potentially pay off all your debts.
Yeah, that's interesting. And one thing that I have is a whole life insurance, and you can actually take out the cash value at any time as a loan,
Right.
and you're still covered. And that's beautiful because you don't have to wait until for the death benefits until you still have to wait. The beneficiary has to wait until you die for the death benefits, but the cash value of the policy grows in interest rates every year.
Right.
And on top of that, you can actually withdraw it as a loan from.
I mean, the loan will be applied to your death benefit. So if you have $1 million policy,
Yes.
you have a $100,000 loan, they get the loan paid back before, so the death benefit would be $900,000 in the case.
Or you can give it back, and that
You
way.
can pay it back anytime. Correct.
Yes. So that's another great one, and people should definitely know about that as well. I want to ask you about mortgages.
Sure.
Can you give people, well, I know you can give people ideas about mortgages because some of my closest friends actually took one of your
Good.
ideas last time, and they've saved tens of thousands of dollars in less than two. So, talk to me about ways to make the bank slave you a little less, or even a lot less with mortgages.
So there's what's called the mortgage equity optimization strategy, which, as you said, will literally save you tens of thousands of dollars in interest and allow you to pay off your 30-year mortgage in 5, 6, 7 years, depending on how the numbers work out. It's an amazing thing. And there's a free website to check out in detail called truthinequity.com. So I'm just going to give you an oversimplified example of how it works. You get a mortgage, a traditional first mortgage at a good interest rate at 4% or something like that. And then you get a home equity line of credit, what's called a HELOC, as a secondary mortgage on it. But a HELOC is liquid. You can put money in, you can take it out whenever you like. And you use it almost like your checking account. Whatever income you have coming in from your job, from your dividends, from your interest, goes into that HELOC, and it pushes the balance down every day. So you're making progress on the principal in the HELOC, where the traditional first mortgage, you make almost no progress for many, many years. Then you do a bulk transfer from the HELOC towards your first, and then you pay off the HELOC, and you just keep doing that. And in the end, you can pay your mortgage off in 5, 6, 7 years. When you go to that website, truthinequity.com, you fill in what's called a personal profile, where you give all your numbers, your income, your expenses, your mortgage, your house value, and they're going to say, based on the numbers you just gave us, it's going to take you 28 years to pay off your mortgage now, and with the numbers you just gave us, it'll be 6.5 years to pay it off, whatever it may be. And they take you step by step through it, including getting the best HELOC. And again, this is something banks are never going to tell you about. They are very happy with the current system where you pay off a mortgage in 30 years. Or even better for the bank, you refinance and start a new clock all over again, because all the interest on a mortgage is front-end loaded, and you make very, very little progress on the principal for many, many years. So that's called mortgage equity optimization. If you get your mind around it, it can make a huge difference in helping you get mortgage-free much faster than you ever thought possible.
It also, just from the personal experience that my friends have had with it, it also makes you an addict for savings. You become,
Correct.
you love savings once you have that.
Every money you can get in there, you're saving that much in interest. It really makes you very aware of the value of money, correct?
One thing I think many people are thinking of is, what are the best avenues to proceed with when it comes to career choices, states to live in, states to retire in, where are taxes low, where is life affordable, and where is development, where are companies coming in, corporations coming in, office buildings being erected, etc. What are your top states for career-oriented people, and what are some of your best ones for retirement?
Well, the tax law that started at the end of 2017 really changed the game and made some states much more advantageous and some states much less advantageous, because it limited the deductibility of state income taxes and property taxes combined to $10,000. So people in high tax states like in New York, New Jersey, Connecticut, California are really getting hit much harder, because what they used to have would be unlimited deductions is now limited, and it means their after-tax cost of housing is going up a lot. So it exacerbated the spread between the high-tax states and the low-tax states. So as far as careers and retirement, I would say it's the same kind of states. I would count that to be Florida, Texas, Washington State, which has no income tax, Tennessee also has no income tax, Arizona has relatively low taxes, and Nevada, no income tax. Those are the places that are growing at the expense of California. People move out of California into Nevada or Arizona. People moving out of New York into Florida and Texas, things like that. So those would be my states that their economies are growing, taxes are low, they're very pro-business, and it's a good place to both work and to retire.
A personal question. One, first of all, where do you reside?
I'm in New York.
Okay.
But I need to be in New York because I'm doing media all the time. I've been here a long time.
Right.
and I'm going to New York City for cultural things, but also to do media. But
Do
the
you own?
taxes are high here.
Oh, yeah, I know. And do you own rental real estate in the United States?
I have timeshares, which has actually worked out well for me. I've got somebody that rents out the timeshares, so much less maintenance than actually owning physical real estate. But for a lot of
And
people, rental real estate can work out well.
and that's U.S. bound?
Yes.
Interesting. Okay. So, let's talk about more out of the box. Okay. Should people consider retirement outside of the U.S.? What would be the advantages and disadvantages to that?
Well, the advantage in many cases is much lower cost, and your dollars, with the strong dollar, will buy you much more in foreign countries than here. I mean, the disadvantages are the cost of living may be good, but the services you get may not be quite as good, healthcare and so on. There could be political instability. But for some people, it makes sense. There are entire communities of Americans where it's almost like you're in America, but just at a much lower cost. Here are some countries that you should consider as far as overseas living. Mexico, there's a lot of expatriates in Mexico. Belize has really nice properties there. Panama, it's got some favorable tax laws. The Virgin Islands, you're a U.S. citizen, but much lower costs. In general, there's a lot of Caribbean islands that might be worth looking at. And my final choice would be Singapore, which is a very well-developed, good weather, very safe, financially strong, low taxes, lots of good things going on in Singapore. So those would be some countries that you might take a look at as far as retiring abroad.
As an American, do you have to give up on any of your social benefits if you retire abroad? Do you not get your Social Security or anything out?
No, you still get your Social Security, and you still have to pay U.S. taxes in many cases as well. As long as you're a citizen of the United States, they're going to get you wherever you are. So it's not as much a tax savings as it is cost of living savings when you go to these other places.
Yeah, and I've seen. I'm actually in Mexico right now as we speak, and I know the expat culture here is very strong, and also in Panama. And I've been around the Caribbean islands a number of times, and obviously some of them are tax shelters, less for Americans, as you say, because you get taxed no matter where you are as a U.S. resident. Do you think that Trump, switching all together here, do you think that Trump is to be praised for the economic conditions domestically, or is this just a cycle playing itself out? In other words, if you were president or somebody else was president, would we still get sort of the same environment that we got from President Trump, or should he take credit for this? How much of the success and failure of the U.S. economy in general do you think is up to business people making decisions and not so much what the government does?
Well, I think the government in this case has helped stimulate business a lot. The two main things they've done were lowering taxes on companies from 35% down to 21%, and a lot of incentives for small business, particularly there's a 20% tax credit, for example, and accelerated depreciation of equipment. That really helped businesses a lot invest. And the other thing is deregulation. They've deregulated the financial sector, entertainment sector, telecommunications, lots of different energy sector to make it easier to do business and keep more of your profits. So I think those have really helped stimulate growth. Now, when he took over, the economy had been growing for 8 years, but it's extended, and it looks like it's going to continue to extend. This is going to be the longest economic expansion in American history. So some of it, I mean, basically the idea is to let private industry do its thing. And by lowering taxes, by lowering regulation, and by giving tax incentives to invest, it has worked to a large extent. So I give Trump a decent amount of credit for these stimulatory measures he's had to make the economy grow.
Now, just to follow up on that, and many people are obviously concerned with this. When you lower taxes, but you do not lower any of the obligatory expenses of the government or the social safety net, you create a wider deficit.
Right.
Obviously, you create a larger debt burden on a government is like a corporation, and the incoming tax are your profits, and your dividends out are these social programs, defense, education, income security, etc. All the items. How does this equation work itself out, in your opinion, or do you think that the U.S. government is in a situation where they're thinking short term and they have this notion that someday they'll need to deal with the national debt, but not tomorrow?
For politicians, it's always easy to put it off into the future. I mean, under President Obama, we added about $10 trillion to the debt. Now, that's because we were in a real hole when he came in and the economy rebounded, but we added a huge amount. We've added a lot now. The current plans are for at least $1 trillion in new debt per year, even with the economy growing like this. You can imagine how much more that deficit would be if we went into a recession or the economy slowed down to some extent. I mean, when you get down to it, the government does three things, okay? It does Social Security, Medicare, Medicaid, entitlement programs. It pays interest on national debt, and it does defense, okay? The rest of it is a rounding error when you get down to it. State Department, FDA, SEC, all that is relatively small. So to get at the deficit, you'd have to cut entitlement spending, which is needed, but it's politically impossible to do that. You know, anybody says they're going to cut Medicare or Medicaid or Social Security, they go crazy. Interest on national debt, you basically have to pay. And defense, we've been increasing. So that's why the deficit is going to keep going up. You could cut out the entire rest of the government and still have a huge deficit because that's just where the money is being spent these days. So I think we just have to get used to rising deficits. As long as we're able to service it, which we're able to do now, it's not a crisis now. In the future, as more and more baby boomers retire and are starting to collect Social Security and be on Medicare, and there's fewer people paying into it, you know, you're going to get some real problems. But right now, people don't seem to be that worried about the deficits.
Jordan, when it comes to the last 10 years, like you said, 2008 until 2019, we have seen a huge wealth gap appearing in the United States. These policies by the central banks, I don't know whether or not to call them even capitalistic. But these very centralized QE programs and expanding of the balance sheets, that's obviously very helpful for anyone with equities, which is roughly the top 10%, the top 20% of the population, where on the other hand, companies have used this low interest rate environment to do more buybacks than to raise wages, etc. And their plans are not to raise wages. If wages are rising, they're going to look to either outsource or automate. So there are many ways for companies to get around higher wages in a tight labor market, which is crushing this middle class, and it's making the ability of poorer people to get up the ladder very small. In fact, a recent study says it's about 1 to 7 people that will escape poverty just to one higher quartile. I'm not talking rags to riches at all. So I want to ask, do you consider America right now to be a very wealth-centric nation?
Yes, it is. And what we just talked about the last 10 years exacerbated that. The Fed's quantitative easing meant asset prices went up. The stock market soared from 10 years ago to now. Real estate values in general went up. And so the people with big assets, real estate and stocks particularly, have done very well. The average person or the lower income people who don't own their homes or don't have much of a stock portfolio or any, haven't really benefited from that. So it increased the concentration of wealth. And then at companies, the gap between what the CEO and the top executives make and the average worker has exploded dramatically. It used to be like 7 to 1. Now it's like 500 to 1, something like that. And this is what is fueling the campaigns of Bernie Sanders and Alicia Ocasio-Cortez and the kind of progressive, if not socialistic, side of the Democratic Party is feeding off of this income inequality. The average person we've talked about has huge amounts of student loan debt and credit card debt and healthcare debt. They're burdened down while the rich people are getting wealthier all the time as these asset values are going up. So some people say this could lead to a social revolution of some kind. But I think it's been getting worse. And the tax cut of 2017 exacerbated even more. The vast majority of the benefits of that tax cut went to corporations, with rates going down from 35% to 21%, and high-income individuals, particularly running small businesses, that get more tax breaks, and their tax brackets came down, and the rates came down from 39.6 down to 37, and in general, the brackets came down. So that, and on top of everything else we've talked about, has exacerbated the wealth gap. Maybe if Bernie Sanders came in and tried to reverse that, it would reverse, but there's going to be a lot of opposition to that by the people who are wealth connected.
Well, one thing we know is that the capitalists are very good at growing the wealth of a nation, but they're not good at including everyone in the spoils. And on the flip side, socialism can help to distribute it, but it usually shrinks the wealth pie. So,
right.
But
yeah, you want to grow the pie and distribute it better. We've grown the pie, but not distributed better. Socialism doesn't grow the pie; it distributes what's left, basically.
Yeah, exactly. Jordan, very interesting stuff, and definitely a lot of practical stuff. Where can people check out a little more? I know you
Sure, I've got a special landing page for your followers, actually. Yeah. They can go to go.moneyanswers.com/wealth and purpose. And they'll see some links to some things we've talked about. I've got a free newsletter that I do every month. I've got a lot of videos. I've got a YouTube channel. I do something called the Money Answers Minute. They can check out a lot of stuff at that landing page or at moneyanswers.com. I got good response every time I'm on your show, and would love to help your followers in any way possible.
Jordan, thank you very much. And we'll have that link down at the description box below, and definitely circle back with you, sir. Thank you.
Terrific. Thank you, Leo. I appreciate it.
What a lineup of guests Wealth Research Group has had this April. Make sure to check out our interviews with Mark Faber, John Rubino of DollarCollapse.com, Harley Schlanger, Jeff Berwick of DollarVigilant.com, Rick Rule, and former Director of Budget Office for Ronald Reagan, David Stockman. Upcoming guests include TF Metals founder Craig Hemke and some very powerful interviews. Make sure you educate yourself as much as possible ahead of this upcoming recession. Wealth Research Group's top 5 books to read are at wealthresearchgroup.com/richbooks. Thanks for tuning in.